Stephen, great to see you. I do want to point out that wholesale inventories also jump in a whopping 0.7%. Is that purely trade, or is it a demand?
We've seen massive swings in inventories for last year, and it's mostly been around this trade cycle. So as you say, we're stockpiling in advance of the possibility of disruptions in the supply chain. It's caused a lot of volatility quarter to quarter in GDP. I'm not sure that necessarily means anything.
So this GDP volatility, we saw a big uptick post-tax cut. Has that faded? Is now just rear window, we've forgotten about it, and it's 2 years out and there's no more impact on that?
Well, that's a consensus view. I take a little different view. I think the key to answering that question is really what happens with business investment. Mm-hmm. Business investment is what benefited from the tax cut, with the cut in corporate rates, the expensing of capital expenditures. And we saw a big pop last year. It's slowed up again so far this year, and I think that's more than anything else a function of caution around the trade situation. If we can get the trade situation resolved, then hopefully we'll get back to normal. I think at that point we would see business investment strengthen, but that's the real question, I think, for the economy going forward.
Can you separate the impact of the trade war and tariffs on the slowdown from other cyclical factors? How can we put each of those into context?
Well, obviously it's tough to quantify, and I think particularly because it's not so much the primary effects of the trade situation that we want to worry about. I mean, people are kind of calculating what's the GDP impact, what's the inflation impact if tariffs go up, and those numbers are small. But the bigger issue is, does it affect confidence? Does it affect consumer and business confidence? As we just discussed, does it affect business investment? Those are the things that could make it a significant player.
I do want to sort of highlight some of the details in the trade data as well. So we're seeing a 2.8 monthly decline in exports and 2.4% increase in imports. Is this going to be like a multinational small cap situation here?
Well, look, I mean, the supply chain disruption has been going on for a while, and it's not all tariff related. So I think maybe I have a little bit different view on this, is that the stimulus created, it's unique, once again, to the United States, right? It created excess in the economy that the Fed can't fix, right? Meaning some of the inventory build was a function of double ordering, right? If I can't get parts because things are overheating, I double order. And then basically when I get my filled, guess what happens? I cancel the orders. Tariffs exacerbated that, there's no doubt. Inventories over the last 3 quarters have grown basically by 3%, 3 GDP percentage points. That's going to have to be paid back at some point, okay? So this is part of our thesis. There's 3 excesses. Excess inventory, okay, it has to be purged. Excess CapEx last year, which now has to mean revert, which is already happening, and then labor. The labor is the one wild card we don't know about yet.